Hey everybody, what's up? Well, I'll tell you what's not up, stock market, another 1,000 point down day in the market. Now, a couple of days ago, Tuesday as a matter of fact, I thought the correction might have been over. We had Friday sit down 666 and then Monday down almost 1,200. And then we had that 575 point rally. Looked pretty good. Bond yields had come down below that 2.85 on the 10-year threshold. And I thought, what I was looking at was very strong fiscal flows. The announcement that the Senate had come to an agreement on a budget deal that would significantly raise federal spending by 400. I spoke about this yesterday, by 400 billion over 2 years. I mean, that is huge, considering that this year we will already, without that, we were set to exceed the 2009 stimulus high. So we were going to get that thrown in there. All right. And I thought that was very bullish, and we had that strong rebound. But apparently, the market is still very much in a corrective phase. Now, we saw the yield on the 10-year, and that's the key thing that you should be looking at here, because the market is keying off of that. We saw the yield on the 10-year rise up to almost 2.89 today. I sent out an email to my subscribers earlier today saying if it gets up around 2.9%, you could add some protection in some of these inverse ETFs or shorting stocks or something to kind of hedge against a downside move, okay, because we own stocks. All right, so it got close to 2.9. It got to about 2.88, 2.885, something like that. And the market sold off again. And interesting on this one, this sell-off, another 1,000-point sell-off, did not bring a very significant pullback in that 10-year yield. Now, I want to add something here which goes back to a prediction I made a long time ago, and something that I have been speaking about on these videos on a regular basis, and that is with regard to my short treasury position, which basically I have had on since December of 2015 when the Fed reversed course on interest rates. And I've said this so many times to you people, it's not about, are the Chinese going to buy our bonds or the Japanese going to buy our bonds or, how much supply is there. It has nothing to do with that. Nothing to do with that. It has to do with the monopolist, the rate setter, and that is the central bank, and that is the Federal Reserve. All right? It has nothing to do with, our debt is so high, and that's why interest... No. Nothing to do with that. One reason and one reason alone why rates move, and that's because the monopolist, the Fed, sets them. Okay? So stop thinking, it's the Chinese or the Japanese or we have so much debt. Oh my God, the debt. No. Listen, the debt was $800 billion in 1980 and the interest rate was 21%. The debt is $20 trillion now. Okay? And what's the Fed funds rate? 1.5%. All right? So you cannot make that argument that it's the debt. Rates have gone way, 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 way down. Why? Because the Fed had continued to put rates down. Now it's reversing course. But here's what I was going to say. With regard to that short treasury position that I have had on, and I would say characterizing that position recently, let's say in the past, 10 months, year, I said that my bet has really become a bet on Fed orthodoxy, Fed behavior, central bank behavior. I said in numerous videos here, it's like I'm a poker player sitting at the poker table with these guys and I can read them 100%. I know the hand they're holding. I can read them 100%. Absolutely without question, because I know their thinking, I know their beliefs, I know their orthodoxy, how they respond. And what do you know today? Dudley, New York Fed President William Dudley, what does he say? Comes out and said, hey, you know what? We could do 4 rate hikes this year. And all along, I've been the one saying the Fed will increase, will accelerate their rate hikes. There will be more than the market is expecting. It will go higher than what the market is expecting, by the way, because each rate hike, all right, it's like a self-sustaining cycle. Each rate hike is a price hike. It raises the inflation rate. It's a net fiscal expansion, so it's pumping money into the economy. So they think they're squashing inflation, or they're slowing down the economy, or they're taking away the punch bowl, when in fact, they're doing the exact opposite without even knowing it. Why? It's their religion. That's what they believe. So my bet, which was on Fed behavior, was so correct. That you see Dudley coming out today and say, hey, guess what? We're not just going to have 3. We'll probably have 4. 4 may turn into 5 next year. So there you have it, folks. If you want to get my report, MMT Trader, I strongly advise you go to my website, pitbulleconomics.com, and sign up for a 30-day free trial and check it out. See everybody tomorrow. Bye-bye.